All right, today we are diving into the latest inflation report. And I know what you're thinking. Inflation reports are so dry. But trust me, you're going to want to stick around for this one because it could be a really big deal for anyone even thinking about the housing market this spring.
So that's the million-dollar question, isn't it? After a really sluggish start to the year, could things finally be turning around for real estate? That's exactly what we're going to break down.
And believe it or not, the key might be hiding in a fresh set of numbers from the government. So let's translate what these figures mean for the housing market, for mortgage rates, and, most importantly, for your wallet.
Some economists are actually calling this new data an incremental tailwind for housing. You can kind of think of it like a gentle breeze at your back, pushing the whole industry forward. And honestly, it's an industry that could really use that push right now. So what's got everyone so optimistic?
Well, to really get it, we have to look at what this January report actually said. So let's dive into the key numbers.
Okay, so the big headline number is this. Overall inflation was up just 2.4% from last year. Now, what's so interesting about that is that it was actually cooler than what the experts were predicting. They were thinking 2.5%. It might seem like a tiny difference, but in the world of economics, those little surprises, they can mean a lot.
Next up is something called core inflation. All this is the regular number, but with food and energy prices taken out, because those things can swing like crazy. This gives you a better idea of the underlying trend. And it came in at 2.5%, which was exactly what everyone expected. No surprises here, and when it comes to the economy, no surprises is usually a good thing.
And now for the number that's really important for our topic today, the shelter index. This includes things like rent, and guess what? It also continued to cool down, slowing to a 3% annual pace. This is a huge piece of the puzzle, since it's the most direct measure of housing costs in the whole report.
So what's the big picture here? What's the trend? Well, after a bit of a spike up to 3% back in September, inflation has been on a pretty steady march downwards. And it's that consistent downward slope that has everyone paying very close attention.
So, okay, we've thrown a bunch of percentages at you. Why does any of this matter? Well, it's because all these numbers have a direct line to something that definitely impacts your life: mortgage rates.
It's really all about a chain reaction, kind of like dominoes. First, inflation cools down. That creates the potential for mortgage rates to ease up a bit. And when mortgage rates drop, suddenly homes become a little more affordable. And when more people can afford to buy, boom, you get a much-needed boost for the entire housing market.
And listen, this isn't just some abstract theory. We saw it happen almost instantly. Right after this report came out, the average 30-year fixed-rate mortgage took a small but totally significant dip. It's real-world proof that this data actually moves the needle on how much it costs to borrow money. The experts are seeing it too. Sam Williamson over at First American, he's the one who called it that incremental tailwind. He's basically saying that as inflation cools, mortgage rates can start to drift lower even before the Fed makes any big moves, and that can help pull buyers back into the game.
Now, to really appreciate why this news is so welcome, we need a little context. This didn't just happen out of the blue. It's coming at a time when the market really needed a win. I mean, the year really got off to a rough start. Home sales were down, not a lot of people were applying for mortgages, the whole market just felt kind of stuck. So you can see why that tailwind we're talking about is such a big deal.
But, and you knew there was a but coming, right? It is not time to pop the champagne just yet. While all the signs are positive, the experts are really urging everyone to be cautious. This is a long way from being a done deal.
And here's a key reason why from Jake Krimmel at Realtor.com. The Federal Reserve, the institution that basically sets the tone for interest rates, they're not going to make any sudden moves based on just one report. They're going to be patient, and they're going to wait to see more data.
That cautious feeling is definitely shared by economist Lisa Sturdivant. She's asking whether we're really in what they call a Goldilocks scenario yet, and she says it's just too soon to tell. She's pointing to the data for February and March as the ones we really need to watch.
And hey, just so we're all on the same page, a Goldilocks economy is exactly what it sounds like. It's that sweet spot where things are just right, not too hot, not too cold. It means you've got low unemployment and inflation is slowly and steadily coming down. It's the ideal situation.
And here is one final dose of reality, again from Jake Krimmel. He makes a great point. January data can be kind of weird. There are all these seasonal adjustments they have to make to account for things like post-holiday lulls. So, the bottom line, let's not overreact to one good month. The overall direction is encouraging, for sure, but it's not enough for anyone to declare victory.
So all of this leaves us with that one big question. We've got some really encouraging signs, what looks like a potential tailwind for housing, and a real glimmer of hope for both buyers and sellers. But is this a true, lasting turning point, or is it just a temporary cooldown? Well, only time, and a few more of these data reports is going to give us that answer.